welcome to the Deep Dive. Our mission today, well, it's pretty straightforward. We're diving into SoFi Technologies' Q3 2025 earnings call. Specifically, we're zeroing in on the CEO's opening remarks. We know you, our listener, want that quick, actionable understanding of their strategy, the big results, and crucially, where they're putting their money now. We're cutting right to it.
Yeah, and if you had to boil down CEO Anthony Noto's opening, it's pretty much this. That long-term one-stop shop strategy, it's here, it's profitable. The whole theme was just confidence, like the company's firing on all cylinders, but also, aggressively investing in what's next.
That confidence really came through immediately, didn't it? He kicked things off saying, and this is a quote, "There's more happening at SoFi today than at any other time in my 8 years with the company." That definitely signaled more than just keeping things going. It sounds like strategic acceleration fueled by these profits they're seeing.
Exactly. That's the duality, right? They're delivering the financial performance now, but they're also taking those profits and plowing them back, not just into the businesses they already have, but into totally new areas. We're talking big pushes in crypto, blockchain, AI, the SoFi Pay thing, and even expanding their banking services for both regular money and crypto. Profitability isn't the end goal here. It's the fuel for the next expansion.
Okay, let's get into that strategy with some actual data. This whole one-stop shop idea, it hinges on members joining, for one thing, like a loan,
Yeah.
and then sticking around to add more services. What are the numbers telling us? Is this cross-selling actually, working?
Well, the proof points really boil down to two things: scale and stickiness. For scale, they added a record 95,000 new members just in Q3. That brings the total up to 12.6 million members. That's a 35% jump from last year.
And more members naturally leads to more products being used, I assume.
Precisely. Another record there. 1.4 million new products added. So the total count is over 18.6 million now, up 36% year over year. But you nailed it with stickiness. That's where the cross-buy rate, or what they call cross-beat, comes in.
Right, the measure of how integrated the platform really is. So how many of those new products were opened by people who were already members?
40%. That's actually the best cross-buy rate they've had since 2022, and it's the fourth quarter in a row it's improved. This is probably the clearest sign that people are coming in for that first product, maybe the loan, and then they stay because, well, the platform makes managing their finances easier. That's what durable growth looks like.
Okay, so that member growth and engagement, how did it translate financially?
It created some serious leverage. You saw it directly in the record financials. Adjusted net revenue hit a record $950 million for the quarter. That's up 38% compared to last year.
$950 million is a massive number. Just to give you some context, that's almost a $4 billion run rate annually. Pretty impressive momentum, especially in this interest rate environment. But let's break down where that revenue came from, because that's where the diversification story really gets interesting.
Absolutely. And this is a big milestone. For the very first time, the financial services and technology platform segments, basically, the non-lending parts generated over $500 million in revenue. $534 million, actually. That's a 57% jump year over year, and it means these segments now make up 56% of the total revenue.
That shift is so important strategically. It moves them away from being overly reliant on the traditional lending side, which, mind you, still grew a healthy 23% to $481 million.
Yeah, but it changes the whole risk picture. This focus they have on capital-light revenue streams is really key.
You mentioned capital-light revenue streams. Can you maybe explain for our listeners why that difference between capital-light and, say, lending revenue is so important?
Sure. It really comes down to risk and how easily you can scale. Lending revenue means SoFi has to hold those loans on its books, right? That ties up their capital and exposes them to credit risk if people don't pay back. Capital light streams, though, like the fees they get from their tech platform or fees for servicing loans, which hit a record $49 million, up 50%, by the way. That's income they earn without putting their own cash at risk. It's just much more scalable and, frankly, less volatile.
Okay, so this success in balancing the growth with profitability, it brings us to that metric people always talk about with high-growth tech, the rule of 40.
Yeah, they posted record-adjusted EBITDA, too, $277 million, up nearly 50% year over year. That's a 29% margin. Net income was solid at $139 million, giving them 11 cents EPS. But yes, the rule of 40.
Right. For anyone not familiar, the rule of 40 suggests that a successful growth company's revenue growth rate plus its EBITDA margin should add up to 40% or more. Why is 40 the magic number?
Well, it's seen as that sweet spot. It signals that the company isn't just chasing growth at any cost, sacrificing profit, or the opposite, hoarding cash instead of growing. It tells investors, look, we're growing fast, but the underlying business is sustainable. And this quarter, Now, SoFi hit 67%. The CEO made sure to point out they've beaten that 40% benchmark for 17 quarters straight now, averaging 58% over that time.
67%. That puts
Yeah.
them in pretty elite territory. But let me play devil's advocate for a second, because the CEO also talked a lot about accelerating spending, right? Pouring profits into these new areas like blockchain and AI. Is there a risk there? When profits are immediately reinvested into things that are still, kind of unproven frontiers?
That is absolutely the balancing act investors need to keep an eye on. Look, a 67% Rule of 40 score is fantastic, but aggressively funding cutting-edge tech, it inherently carries more risk than just, say, maximizing your current cash flow. This strategy is clearly a bet on grabbing future market share and getting that technological edge. It's not about delivering the absolute maximum short-term profit right now. They're banking on the idea that their integrated platform offers the highest lifetime value, or LTV, which justifies spending big upfront.
Interesting. So even with these incredible numbers, the CEO's message is basically, we're just getting started.
Yeah.
He sounded really optimistic about 2026 and beyond, especially highlighting their unique position to benefit from both AI and blockchain supercycles. He noted most competitors are really just focused on one or the other.
Yeah, that dual capability seems to be the core of their next strategic phase. But, before they fully max out the tech, they're still working on the brand, like that partnership with Josh Allen, the NFL MVP, promoting SoFi Plus. Apparently, that drove a 35% jump in unaided brand awareness in their target group.
Which, in turn, pushed their overall unaided brand awareness to 9.1%, an all-time high, and like 4 times higher than when they went public. That brand strength is key, right? Makes it cheaper to acquire members down the road.
Definitely. Okay, so now the tech. Starting with blockchain, there's SoFi Pay. That's their first payment product actually using blockchain tech.
And they specifically mentioned using a Layer 2 network. For those of us maybe not deep into crypto development, what does using Layer 2 actually achieve here?
Think of Layer 2 like an HOV lane on the main blockchain highway. It lets them process transactions, in this case international payments, much faster and at a lower cost. They launched it for payments to Mexico first, but Europe and South America are apparently next on the list.
They also brought back the ability to buy, sell, and hold crypto in the app. But again, leveraging that integration, you can fund it instantly from your FDIC-insured SoFi Money account.
Right. And all this leads up to what might be their biggest strategic move planned for 2026, the SoFi USD stablecoin. The CEO really emphasized their unique advantage here. They are a regulated Tier 1 bank.
Okay, that is a huge difference. What does being a regulated Tier 1 bank let them do with a stable coin that, say, other fintechs or crypto-native companies just can't?
It fundamentally changes the cost structure and the risk profile. Because they're a regulated bank, they can hold the reserves backing the stablecoin directly at the Federal Reserve. That means earning the Fed funds rate interest with, as the CEO put it, zero credit risk, zero liquidity risk. Essentially, they can create a stablecoin backed by ultimate institutional safety and potentially pass that yield and safety benefit straight to you, the consumer. This is a serious threat to pretty much every other stablecoin issuer out there and maybe even traditional banks.
Wow. Yeah, the disruption potential there, if they pull it off, is kind of staggering. Okay, let's switch gears to AI. We heard about internal uses helping operations, but the tools facing the members seem like where that platform integration really pays off.
Oh, absolutely. The AI-driven Cash Coach is a great example. It scans not just your SoFi accounts, but your external ones, too, looking for ways you could be using your cash better. I mean, we all know that feeling of seeing, 2 basis points interest in a savings account at a big bank, right? The CEO gave an example. The coach suggesting someone move cash earning almost nothing to a SoFi account, getting 3.8% APY, or maybe suggesting using that cash to pay down a credit card charging 25% interest. That's immediate tangible value for the user.
That kind of personalized advice definitely builds loyalty. And that seems to lead into the planned 2026 SoFi Coach.
Correct. That's envisioned as this comprehensive tool. It's supposed to pull insights from all your financial activity spending, paying down debt, your investments to help you basically spend less than you make and invest the rest.
Right.
This is where that integrated platform could become like an essential financial co-pilot.
Okay, let's quickly run through some of the specific product updates in the different segments that feed this whole ecosystem. Starting with the loan platform business, LPB. The CEO called it a game changer for diversification.
Right. The LPB is a huge part of that shift towards capital light revenue we talked about. Just to clarify for everyone listening, how exactly is LPB different from their regular lending business?
So LPB is basically SoFi making money off loan demand they couldn't previously handle themselves. Instead of funding the loan with their own money, they act more like a facilitator. They originate the loan and then sell it off to partners, collecting fees along the way. They did $3.4 billion of these in Q3 alone. That puts them on pace for over $13 billion a year. It's basically low-risk fee income for them.
Interesting. And the CEO also mentioned something about partners actually leaning in to do more business with SoFi now, especially as concerns about private credit are rising elsewhere. He called it a flight to quality.
Yeah, that sounds great, but is there maybe any data suggesting this flight to quality is just temporary? Or maybe it's just that competitors are tightening the standards, pushing business to SoFi, rather than it being purely about SoFi's superior quality?
That's a fair point to raise. While the CEO frames it as validation of their strong underwriting and their focus on high-quality borrowers does support that it's also very likely that broader economic caution is making other platforms pull back. So if the economy picks up significantly, maybe that partner demand cools off a bit. But right now, yeah, they're definitely benefiting from it.
Okay, moving quickly through the other areas. What about SoFi Invest? Any highlights there?
Yeah, a couple things. They finally launched Level 1 options trading, which was apparently a big request from users. They also expanded access to IPOs, mentioned StubHub, Figma, and launched their own ETF, the SoFi Agentic AI ETF. Plus some convenience stuff, like 247 instant transfers between your Invest and Money accounts.
And the SoFi Money side, which has ballooned to 6.3 million products since they got the bank charter, is getting a new product hook too.
That's right, the SoFi Smart Card. It's part of their SoFi Plus membership bundle, and it's rolling out now. Key features are things like 5% cash back on food, that high APY on your deposits, and it even has credit builder features. Again, it's not just another credit card. It's designed to be another sticky product, pulling people deeper into the whole SoFi world.
Got it. And finally, the traditional lending segment. Still very focused on those high prime borrowers. FICO scores in the mid to high 700s.
Exactly. Average FICO for personal loans was around 745, and for student loans, 773. High-quality borrowers. And their credit performance seems to reflect that, which is pretty impressive given what's happening in the broader market. Net charge-off rates actually improved last quarter, down more than 20 basis points for both personal and student loans.
And they're innovating there too, trying to help members get out of high-interest debt. Mentioned something about an interest-only period on personal loans.
Yeah, the idea is to make it easier for someone struggling with, say, 20% plus credit card interest to transition to a lower rate SoFi personal loan, maybe around 12%. The interest-only period gives them breathing room initially. They also mentioned gradual step-up payments for student loans and estimated that members who refinance student loans in Q3 alone will save over $100 million in interest.
And home lending seems to be taking off, largely thanks to that new home equity loan product.
Yeah, home lending hit a record $945 million in originations. The home equity loan product itself did $350 million just in Q3. The CEO actually expects Q4 revenue from home loans to be higher than student loan refi revenue. That'd be the first time ever, signaling a really significant, maybe permanent shift in their business mix towards more diversification.
Wow. Okay. And last but not least, the technology platform, the B2B side.
Big news there, too. A new partnership with Southwest Airlines to power their Rapid Rewards debit card. Plus, they apparently signed 2 other major consumer brands, their largest clients ever, though they didn't name them yet. That really validates the strength of that B2B tech offering.
Okay, so let's wrap this up.
Yeah, to really summarize this whole deep dive, the CEO presented a picture of a fintech that successfully made the transition from basically a single product lender to this diversified, profitable platform. And they're leveraging that strong performance, that 67% Rule of 40 score, to really hit the gas on these big bets in AI and blockchain.
Right, and that final message from the CEO was pretty clear. The success, he argues, comes from their sustainable competitive advantage with the highest lifetime value, all driven by that integrated, seamless platform. That's the core belief driving all this investment.
Which leaves us with maybe a provocative final thought for you, the listener, building on that unique advantage we discussed earlier. Remember the planned SoFi USD stablecoin? Backed by their status as a regulated Tier 1 bank, allowing them to hold reserves at the Fed. Just think about this. What are the ripple effects across the entire global financial system when a stablecoin provider can tap into that kind of institutional safety and potentially pass that zero-risk interest back to everyday people, essentially bypassing a lot of traditional banking infrastructure? That Tier 1 bank status, it's a competitive advantage, maybe even a moat, that's definitely worth keeping a close eye on.
Definitely a lot to think about as this strategy keeps playing out. Thanks for joining us for this deep dive. We'll catch you next time.